I'm Foreman, and in this week's portfolio update I'm going to show you the UK stocks I bought, as well as the top risers and fallers in the portfolio. And if you enjoy the video, please drop one of these to support the channel. And yes, my hair's messy. It's at that awkward length stage where I can't really style it, or I don't have good enough products to style it properly, so I'm just going to look a bit like this for a while. According to Google Finance, the FTSE 100 is down 2.34%, the FTSE 250 is down 0.52%, and the S&P 500 is also down 1.96%. My portfolio has underperformed the markets this week and not done very well at all, dropping by 5.55%. And that's due to this continued correction that we're experiencing, and it could possibly become a crash, although I don't personally think so. I'm very happy that the markets are dropping, as this means there's more opportunity to buy into the quality stocks that I hold already, and therefore more time, or this short-term blip really isn't going to matter over the longer term, as I believe over that longer term period the markets are going to be up anyway. And it seems like stocks at the moment are actually dropping due to the bond market spiking, and this is due to a fear of inflation. This basically means that people are worried about inflation happening. So the likelihood of the amount of cash being printed, or the increased amount of spending that we may see when the economy reopens, could lead to inflation to rise, therefore forcing the hand of the likes of the Bank of England, or in the US, the Federal Reserve, to raise interest rates. At which point interest rates rising isn't good for stocks, as this means bonds and savings accounts, for instance, they look more appealing. Therefore people might decide, you know what, it's risk-free, I'm going to put my money into these lower risk corporate government bonds, and I'm also going to put my money into savings account and sell my stock positions. Whereas when interest rates are very low, for instance, at the moment, for instance, no one wants to put their money in a savings account, and bonds are so low, it's just not worth putting them there. So a lot of people are putting their money into stocks instead, leading to more people buying, pushing valuations higher. This is important because I believe that valuations will see a significant re-rate, that we may see stocks drop a lot further. And if I think stocks are going to drop a lot further, why am I not selling all my positions, as most of my holdings in the portfolio are a premium, and therefore this could mean that they could get hit very hard. Simply put, I can't time the market, as I'm not a seer. I can't see the future and I don't know when it will bottom out. Therefore, it's best that I believe that I will just continue to pump money into the markets and buy whenever there is a low, or buy consistently really. But what I can do is I can wait. By wait, I mean the likes of putting more money into the markets when they drop. This means that instead of just putting my average weekly deposit of £125 in, I will then add additional sums of money to therefore try and take advantage of these dips. It's not necessarily timing the market, it's just using the spare cash I have on the side. But at the same time, it hopefully allows me to get better acquisitions and better prices for the long term, hopefully increasing my overall returns over a longer time period. And then if it continues to drop further, I will just simply add more money into the markets, and that's exactly what I've done this week. And I've made a fair few stock buys. I'd just like to make a personal announcement before jumping into the top riser and faller, and that is to do with the channel and health. Recently, I've noticed that I've been getting symptoms of high stress and also fatigue, and leading to potentially a burnout. I love investing, I love the stock market, but at the same time, when I'm doing it pretty much every day, it's very draining on the mind. What I've noticed is a few symptoms like clenching my jaw, or like grinding my teeth, or the likes of jittery hands. At the moment, they're okay, but usually like my finger or something is shaking, could be from fatigue from typing. Regardless, I've got a doctor's appointment for next week to deal with it. But the point is that I've been trying to put YouTube to the side for a bit, just to protect the longevity of the channel and being able to continue creating content in the future. So if I look after my own health first, this could mean that hopefully I don't just quit YouTube at any point in time. Oh, and no, I'm not on drugs. I've recently gone caffeine free, as I did look a bit hyper in some videos too, although I have just got over the whole tired withdrawal period, and I think I'm back to normal, hopefully. But yeah, I have actively tried to spend less time on the channel in this short-term period. And that means if you've left a comment and I've not responded, please do not worry, as I will get to it when I can, but please understand it will be later than usual, as I am a fair few days behind, and it honestly takes hours to respond to everyone in as much detail as I'd like to. Although I'm also thinking of changing the format of my content so that it's less research intensive, but also can provide the same amount of value. A prime example of this is the stock analysis series. This takes a lot of time to create, and I have to do a lot of research so that I feel that I'm able to therefore talk about the stock. But usually what happens is, because I'm so overwhelmed with short deadlines and trying to get this high level of research involved, is that I end up missing out on some critical pieces of data, much like the GGP video or Greatland Gold. What had happened is I'd gotten a lot of negativity, and don't get me wrong, hate comments really can't get to me. If anything, I find them funny. But what I have found is that they can get quite draining, because if you read it as you're doing other things in the day, you're going to have that negative thought inside your head, even if it doesn't impact you that much. The more of them you have, the more it's just going to impact your mood, and you may just be less productive or more likely to just give up or be less willing to work, for instance. Which means that dealing with this level of negativity makes it difficult to want to put out stock analysis videos, and it's very likely I'm going to stop this series in the future. I do have plans on how to continue it, but using a video format makes it so much more time consuming than it really needs to be. But I am going to be changing a few things on the channel and adding a new series as well. The stock tip of the week, I think that's going to be too stressful. I'm very likely not going to continue with that, but I want to create a video content series that has more wider appeal rather than picking on specific stocks, because after all, those specific stocks have only really got an appeal to someone interested in buying or they already hold, which is likely a minority of the channel that are subscribed, for example. But I'm going to talk more about what I plan to do with the stock analysis series in its own video in the future, and I will get back to the portfolio. The top risers in the portfolio start with Ashtead Group. No surprises, it continues to outperform both the rest of my holdings in the portfolio and the market, only dropping by 0.61% this week. I believe AHT is my only value play, and therefore in a time where most of my premium stocks are being squeezed of their valuations, Ashtead Group has still got a large buying demand. Because of this, I've actually taken profits prior to their upcoming results in the next week or two, as I would like to crystallize those gains, as it is up a significant amount of over 50%. I then crystallize the profits in a stock. I've then reinvested that money elsewhere to take advantage of the stocks that have actually dipped in this correction. By selling 5 shares, I was able to lock in these profits, still have a majority of my position to benefit, but also then reinvest that into other stocks in the portfolio. Such as one of the top risers this week, but over the last few months is definitely a top faller. That stock is Games Workshop, and this week they have dropped by 1.55%. But compared to my other holdings, that's quite minor. I think they're suffering from both the market correction and also a change in investor sentiment. People had begun to start taking profits, in my opinion, and therefore this one is getting squeezed more than others I've personally seen in the market, or at least in my limited market vision. I personally think it's great. Games Workshop shares dropping is brilliant. Changing that valuation to a lower number, or price to earnings, means that I'm more inclined to buy more, and sure, I've been averaging up for ages, since around £70 per share, and my average is around £90 odd per share. So continuing to build this position over that longer term period, but being able to buy more now at an earlier stage is really something I'm a fan of. And therefore I have bought an additional share of Games Workshop, bringing my total position size to 63 shares. And my total performance since initially investing in June is now only 5% because of how much I've averaged up this position. Another stock that I had bought this week was Team 17, and this has been followed through of their correction in the last week, as they dropped by a significant amount and shares continue to drop, falling by 3.31%. I strongly believe that Team 17's valuation is going to continue to be squeezed, and I believe that this is an industry-wide appeal. The likes of FDev or Frontier Developments, they're the creators of Elite Dangerous, another UK developer for games. They've also been seeing this valuation squeeze as well. I believe this will continue. Lots of people put money into it over this lockdown period as they're benefiting from the lockdown, and so it makes sense as to why people or investors may believe that this may not continue. I believe against it. I think that they've simply advanced a few years, and therefore their growth may continue, but not as at a fast rate. And that's why I've been continuing to buy Team 17. And the opportunity to average down so that in the future, or over the long-term future, I may have a lower price and therefore higher percentage returns, is something I'm not going to just avoid. So that I'm well positioned that once this negative trend reverses, even if it takes the next 5 years, I could build up a substantial amount of capital in this position. And therefore I've bought an additional 32 shares, bringing my total position size in Team 17 to 138 shares. But it is still the smallest position in my portfolio for now. One stock I had spoke about last week and the possibility of selling is Halma, and I've been giving praises since I bought this business in July 2020. However, I believe that the safety and lower levels of risk in this investment are not for my investment style. When I first started, I went for more lower risk stocks. However, I believe that my risk tolerance is much higher, and especially at a young age and where I won't need this money or don't invest what I can't afford, then I'm more capable of taking risks. So if there's a time to do it, why not now? If I don't take these risks now, in the future where I have a lot more wealth, I might not want to do it. I might want to preserve my capital more, or I might be closer to needing to depend on it, as I'm looking for the best amount of returns as I can get to rapidly compound my wealth so that I can get to that stage where I look to preserve my wealth and invest in stocks like Halma with lower volatility but consistent growth potential. Right now, if this correction continues or it goes into a market crash, then it's likely that I can take advantage of the lower volatility that Halma has. Other shares will drop by a further amount than Halma. I will then happily sell this position at a loss and buy into other stocks that have been beaten up even further. Whilst, as I said, I think Halma is a high quality company, I think it doesn't fit inside my investment strategy. Sure, my position with Halma is down 2%. That means if I sold now, I would be taking a loss. And sure, they certainly have a lot of scope for the future, but I feel that my cash could be better placed elsewhere in a sector that I understand with more comprehension. That way I can have a higher conviction on my investments and not have doubts about them 6 to 9 months down the line. I don't have doubts about Halma, but I'm not a specialist scientist or an engineer, so I'm immediately at a disadvantage because I do not have that level of comprehension or understanding in this specific industry. Regardless, I still hold 54 shares. It's the second smallest position in my portfolio, and I have not sold any just yet. But what I'm doing is I'm preparing myself for this possibility in the future so that if there is an opportunity where I may need to sell or free up capital, I would willingly be able to free up Halma without any emotional attachment so that I could then buy the dip of another stock. I'm basically revealing my hand so that in future I'm more prepared for these outcomes or possibilities. Shares in Halma are dropped by 5.86%, making it my top third faller in the portfolio this week. Boohoo, my largest holding, has also seen a significant decline of 5.92%, likely dragging down my portfolio the most this week. And I've had a lot of people asking if it's still worth buying Boohoo, and I personally think that they are actually undervalued. And is it worth buying at this valuation? I think Boohoo has a lot of potential for the future, especially compared to the likes of ASOS. This is because it's not going to suddenly stop growing just because they benefited from the pandemic, but rather I think consumers, they're going to spend a lot more money on clothing. They want to go out, they want to go impress their friends, so it's very likely that this consumer target audience of 16 to 34-year-olds are going to go out clubbing once it's June. And then what will happen is more people will be spending money on clothing and Boohoo will continue to grow. Sure, this is a short to medium term time period and they may see extended benefits from the pandemic and it may slow down over a 5-year period, but I still believe that their growth potential will continue. They're exposed to the US and there's a lot of growth potential there, especially when considering that the market share in the US is much less compared to the amount they have in the UK. Furthermore, compared to the likes of ASOS, which has lower margins for the record because Boohoo sells their own products, but ASOS has bought the likes of Topshop for a very ridiculous valuation and they've not diversified their consumer audience. Rather, they've bought into the same market audience that they already have. I might have been at that age, I might have bought at both Topshop and ASOS, but then I would have done it for the convenience of the high street stores. Now I'm going to be less inclined to, and therefore I feel that that's a bad purchase of it. Whereas Boohoo, they've bought more diverse brands, the likes of Burton, Wallace, Dorothy Perkins. We've also got the likes of Debenhams. This diversifies their consumer base and therefore gives them more defensiveness, but a greater overall market share in the wider audience of things. And this also gives them expansion into the potential of beauty with the likes of Debenhams. But the reason I'm not buying Boohoo is simply because I'm overexposed to Boohoo in my portfolio and I don't want to over systematically risk it. Therefore, whilst I think they're at a good valuation and would top up, I'm not buying more shares, as when I deposit more money with my paycheck, that money will go into my other stocks so that it slowly becomes a smaller proportion of my portfolio until I'm at a size that I'm happy with, rather than just selling the position now and missing out on the long-term growth potential. I still hold 2,500 shares of Boohoo. Argo Blockchain has seen a 20.71% decline. And sure, that's high volatility, but at the start of the week it was propped up by ARBKF, their dual US listing, and basically in that situation it had done really well on Friday evening of trading, and then on Monday it opened really high and immediately dropped. Bitcoin has dropped at the same time, so that's likely caused by that, but I'm not worried at all. I'm not concerned. This is still a short to medium term play in my opinion, and they've still got to be listed on the NASDAQ, which they still have the requirements for, and so it's probably not that long away. Therefore, I'm buying more shares of Argo Blockchain. I believe that they've still got a 3 to 4 times potential, nice. And I've bought an additional 178 shares into my Freetrade ISA, bringing my position size to 607 shares. And if you'd like to sign up to Freetrade, I've got a link in the description down below, and you can also get a free share when you sign up. And then I've also got my Trading 212 general investment account with 1,068 shares that once they're listed on the NASDAQ, the volatility then begins to lower. I will then take my profits, sell the entire position, cash out of Trading 212, and then move that money into my Freetrade ISA. But I may not rebuy Argo Blockchain at that point. And if you have any questions, feel free to leave a comment, as I'm going to be creating a new series that will involve them. If you're interested in how I got suspended by Trading 212, then click the card at the top right of the video. Thank you for watching, have a great afternoon.